Hi everyone and welcome to Swissquote's Daily Market Talk. It's Friday, the 15th of May. What a week it has been again. The data released this week confirmed that inflation is rising globally and rising faster than the expectations. Bond yields are reacting by screaming higher as well. Oil consolidates above the $100 per barrel level with no major progress in the Middle East conflict, but none of that seems to matter for equity investors. The S&P 500 and Nasdaq hit fresh record highs again yesterday as investors continue to throw money at the AI trade. The question is, are investors missing something? So we will talk about that and more, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
Now let's start with this week's summit between Donald Trump and the Chinese President Xi Jinping. Well, the summit went pretty well, except a few sticky points around Taiwan. The two leaders complimented each other. Trump was quite soft and nice, while Xi Jinping struck a firmer tone invoking the Thucydides trap, the idea drawn from the rivalry between ancient Athens and Sparta that war can become inevitable when a rising power challenges a dominant and an already established one. But at the end of the day, the two countries somehow agreed to ease the trade tensions, mostly on non-critical sectors, agreed on some investments. China even said that they would help with the Iran negotiations to open the Strait of Hormuz. So markets rallied with joy, ignoring the ongoing Middle East tensions somehow, their impact on oil prices, and the inflation figures. Because yes, inflation data released throughout this week confirmed the rising inflationary pressures in the Eurozone and warned that inflation in both consumer and producer and were accelerating faster than expected in the US as well. The latest US PPI data jumped to 6% in April, the highest in more than 3 years. The Japanese PPI print this morning echoed a similar rise. It came in at an eye-watering 5% level, the highest since mid-2023. So rising inflation kept pushing bond yields higher around the globe, reflecting the continued hawkish pricing across the global central bank expectations. So in this context, the US 2-year yield that best captures the Fed rate expectations spiked past the 4% level. And wait, the Japanese 10-year yield spiked more than 3.80% just today to nearly 2.75% level today in Japan, to nearly 2.75% level, far above the 1.75% mark pointed as the level where Japanese institutional investors like life insurers, pension funds and banks could start seriously preferring domestic bonds over the hedged foreign debt, remember. And that's quite disquieting to say the least. US crude on the other hand is pushing higher again this morning above the $102 per barrel level as traders are swinging between clashing announcements from Donald Trump today, saying on one hand that the US could live without the Strait of Hormuz a few hours before urging reopening the Strait of Hormuz. Meanwhile, the US oil inventories fell 4.3 million barrels last week and around 12 million barrels over the past 3 weeks as the US crude exports are rising due to the Middle East tensions to fill in the Middle East gap. And energy prices will likely remain elevated in the foreseeable future given the little progress that we see in the Middle East talks, and many consumer-facing companies like McDonald's, for example, have been insisting that the US consumers are running out of money. And retail sales data released yesterday hinted at resilience again in the month of April, but underneath the surface, 13.1% of US credit card balances are now 90 plus days delinquent. And that's the highest level since 2011. It simply means that Americans today borrow to spend and they are delaying their credit repayments. That sounds like a ticking bomb. But guess what? The S&P 500 and Nasdaq didn't care at all. Both hit fresh record high yesterday, no matter what. And indeed, the technology has done amazingly well since the beginning of the war in Iran, somehow getting away with the rising energy costs and supply chain disruption risks. It's not that these companies are buying stuff from Middle East or are not paying for energy, but the AI growth outlook and optimism that the latter will accelerate revenue generation is outweighing the geopolitical challenges. Simply, Brown Hill's Magnificent 7 ETF, for example, rebounded nearly 30% since the war lower dip to a fresh all-time high level again yesterday, supported by strong earnings and even stronger guidance. Cerebras, for example, which is an AI chip company that went public yesterday, surfed on a giant wave, jumping around 70% in its first day as a publicly traded company, giving it a market cap of around $95 billion US. It's been the biggest IPO of the year so far. So globally, investors totally brushed aside the circular deal worries, remember those, and their frustration with the massive AI spending from the technology companies, increasingly financed by debt. But no one cares about that, and no one cares about the rising yields either. And that's curious, and that's somehow disquieting. Because yes, the technology stocks have done very, very well during the latest Federal Reserve tightening cycle, post-2022, to fight the post-COVID and the post-Ukrainian war-led energy crisis. And one of the reasons for that was because the big technology companies like Microsoft, Google, or Meta had ample free cash in their hands and relatively lower debt compared to other companies, which made them less sensitive to interest rate hikes, also defying the theory that growth stocks would be hit harder by higher interest rates as their valuation is highly dependent on future revenues, when discounted to today would be smaller if interest rates rise. Today, investors treat the technology stocks in the same way, thinking the technology stocks could simply defy the Iranian war, the rising energy prices, the rising inflation expectations, and the prospects of tighter than otherwise monetary policy from around the world. The problem is this: the massive capital expenditure is tapping into their free cash flow today and oblige these companies to seek funding through bond markets. That kind of sucks, because that makes the big technology companies more vulnerable to interest rate hikes compared to earlier cycles. Take Amazon's 1.5% coupon bond due June 2030, for example. It now yields around 4.40%. It still covers the US inflation and offers a certain premium, but the price is falling as inflation expectations push the US yield higher. That means that cost of borrowing is rising for technology companies that are together expected to spend up to $1 trillion in AI infrastructure this year. And what happens if these companies just back down? What happens if they decide to reduce their AI spending? Well, it will be worse, because the actual valuations are fueled by the prospects of future AI-led revenue. But if the companies stop investing, they will hurt capacity constraints that could limit the income potential, a scenario that's not favorable for valuations. Or maybe it's me, but I feel today that Microsoft services, for example, are somehow slower to react, and that's exactly what these companies are trying to avoid. Second, the circular nature of these deals suggests that if one company backs down, it could trigger a domino effect across the rest of the companies in the same circle. You know, the Anthropic circle, you know, the OpenAI circle. So the big technology today is at an important crossroads. Investors have digested the massive AI spending, the circular deals, and the high valuations. Yet for the rally to extend further, the macroeconomic context should also remain supportive. And today, looking at the global yields, the macro context is not supportive. And the longer the Middle East war prolongs, the higher the energy prices rise and fuel inflation expectations and borrowing costs, the higher the cost of building that extra data center will be. This, I believe, is a red flag that many technology investors have been completely ignoring today, certainly blinded by the shiny earnings and even shinier earnings expectations. But I would still keep in mind that these expectations do not fully reflect the risk of another period of sticky inflation. And this time around, the big technologies got less cash in their hand to temper the stormy oceans. Else, there is one more possibility, of course, that the Iran war will end, the inflationary yields will come down, and markets will further rally on relief. So I will leave it here on this optimistic note for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.